Okay, good morning, everyone. I'm Mary Preenon. I'm the Director of Communications for the Hudson Gateway Association of Realtors. And I want to welcome you all to our Breakfast with Benefits series. It's been on Zoom now for, I guess, about a year. So some people have asked when we're going back live. I don't know, probably not until 2022, but that's okay because we like our Zoom. And we have a really great program for you today from our friends at Valley Bank. It's called Mortgage 101, everything that you wanted and need to know about mortgages. And our special guests are Mike Muldoon and Rob Dominguez from Valley Bank. So Mike, the floor is yours. Take it away.
I'm sorry. Thank you, Mary. Good morning, everyone. It's a pleasure to be with all of you this morning. First of all, I just wanted to thank you for taking the time out of your morning to be on this webinar today. Most certainly, it's our goal that you feel your time was well spent being on this call. So with that, I'd like to introduce Rob Dominguez. Rob is one of our top home loan consultants at Valley Bank, and he will be presenting with me this morning. So I think we'll just jump right in. I feel like
Rob, I'm sorry,
I feel like the Jeopardy host. I've got to share my screen, right?
Sorry, I forgot to mention, if anyone has questions, if you can wait till the end of the presentation, and then Mike and Rob will go through the questions and we'll get to everyone. Thanks.
Very good. Okay, so I think I'll just share my screen, Mary, right? I think I'll just pop into the presentation here. Hopefully everyone can see my screen. All right. Everyone good? Everyone thumbs up? Thumbs up?
We can see it.
All right. So, so as Mary had mentioned, our webinar today is Mortgage 101 and beyond. So understanding some key concepts and terminology in residential mortgage lending, help you get more comfortable with that piece of the business. So what are our objectives for today? What we hope that you take away. Gain an understanding of the key factors involved in approving a borrower for a home loan. You know, what's that process look like? Understanding some common terminology used in home mortgage lending and why it would matter to you. And then sharpen your knowledge of important differences in major lending programs, because there are definitely some unique things to be aware of. Okay, so jumping right into more of the big picture, you know, we'll zoom in from here. So, you know, some of you may have heard in the past that, you know, there's 3 C's of credit, 5 C's of credit, 7 C's of credit. I like to land on 4 C's of credit. I think 4 C's of credit, 4 C's of credit of lending, excuse me, really hits on the big stuff. So, you know, what are these 4 C's of lending? Well, they're credit, capacity, capital, and collateral. So when we approve a loan for a borrower in a pre-approval state, pre-qual state, you know, we're looking at all these different characteristics. You know, we're looking at their income, we're looking at their assets, we're looking at their credit history. At this stage, we're not looking at appraisal, but obviously that's one of the big 4. Okay, so we'll jump into, you know, a couple of these big 4. So credit. So I'm going to read a little bit here, but then, you know, I'll embellish a little bit as we go, and Rob will jump in as well. So credit. When we look at someone's credit, we ask, you know, we're looking at going, are credit scores high enough for any or all loan programs? So is this borrower going to have a whole variety of options available to them, or are they going to be limited? Or is there nothing we can do for the borrower right now other than educate them on how to improve their credit scores in order to become eligible? So how established is the credit history? Sometimes we'll come across borrowers with very limited history. They don't have to have extensive history like they've had in years gone by in order to qualify. You can have a borrower with very limited credit history, and as long as it produces what's called a score, a valid score, then they're potentially approvable. Then we look at, you know, are there any derogatory items that we need to address that can impact approval? You know, so what does that mean? So has someone had a previous bankruptcy or foreclosure? Do they have any current judgments? Do they have a tax lien? Do they have something that's going to impact our ability to approve them for a loan? And if so, you know, how do we address that to counsel them on how to deal effectively with those items? So some key terms, and throughout the presentation, we'll bullet point out a couple of things called, key terms and key tips. So things that you should take away of, things to keep in the back of your mind so that you understand some of these, these acronyms and these terminology as it's brought up. So key term, Fico Score. So that's Fair Isaac Corporation. So Fair Isaac is a modeling system that generates credit scores that the three major credit bureaus use. So all three bureaus use the same scoring system, but they have slight nuances in how they use FICO. And there's reasons why a FICO score might vary a little bit from bureau to bureau, which I'll talk about in just a second. Key tips. Most borrowers will need a minimum score of 620 credit score in order to qualify for a loan. And when we say credit score, that's what we use in the industry, but FICO and credit score kind of go hand in hand. FICO creates the credit score. Credit score is what we use. So what's a range of credit scores? So a range of credit scores would be 300 to 850. We see very little 300s. We see very few 850s. Most people fall in a band of 660 to 760. That's where you see most people. Obviously, we get some above and some below. Borrowers have three scores, one from each of the three major credit bureaus. So Experian, Equifax, TransUnion all generate their own score. Lenders pull in what's called a tri-merge report that brings them all three scores. Most lenders will use the lowest middle score of all borrowers on the loan for pricing the loan, pricing meaning interest rate, and mortgage insurance. PMI insurance is driven by credit scores. That's a big factor now. And for the approval process, of course. So when we say lowest middle score of all borrowers, so we have 4 borrowers on the loan, we could have 3 that have 760 middle scores. We've got one that's got a 660. 660 is going to be the driver on pricing and approval. And obviously we look at that when we see something like that, and we will look and see, hey, is it necessary for that borrower to necessarily be on the loan? They could be on the title, but they need to be on the loan because they might have an impact, negative impact on the approval or on the pricing. So, but that's the key tip for you to understand is the range, the minimums, and that a borrower has 3 scores. There are some programs out there that exist in the government world, in the government lending world, which we'll talk about in a little bit, will allow below a 620, but that's not the mainstream lending world. So let's jump to capacity. So capacity, what is this? This is all about income, right? The borrower's ability to afford the loan. So what do we look at there? We look at, is the income stable? Is the income consistent? So that's what an underwriter is going to look at. So that's what we need to look at as loan officers. Is the income strong enough to support the borrower's current monthly debt? So that's credit cards, car loans, student loans, whatever they may have, even another mortgage potentially, or a rental property. So what is the current mortgage debt obligations plus what's the new projected mortgage payment? So we have to pull that all together in order to determine, hey, can they afford all this on their income? So key term here that you'll hear from time to time is debt to income ratio. So what is that? Well, that's basically adding up all their debt, their monthly service debt. And if it's not monthly, you have to break it into a monthly, and then dividing that by their gross income. So when we lend with gross income. We don't lend on net. We lend on gross. And you might have a question in your mind about Social Security. Well, we gross up Social Security because most of the time Social Security is already kind of a net income. So we will gross that up. But essentially, we're looking at total debt divided by income. That produces what's called a debt to income ratio. And in a little bit, we'll see what those ratios look like depending on the program. Another key term, PITI. So this is principal, interest, taxes, and insurance. So commonly people will say, what's the PITI? What's the PITI on the loan? Well, it's principal, interest, tax, and insurance. Now, we of course have to add to that if there's any HOA. So if it's a condo and there's an HOA fee, we have to build that in. If it's a co-op, well, we have to add in the maintenance. But if there's a co-op, as you know, there won't be any additional payment for taxes because there are no taxes that are actually paid. The taxes are handled through the maintenance. So basically it's the principal and interest and the maintenance and whatever insurance is necessary to protect the inside of the unit. So that's what, when you hear DTI, when you hear PITI, That's what we're talking about. So key tip: bonus, commission, tips, overtime, part-time work, self-employment, all require a 2-year history. So the idea there is back to, is income stable and consistent? So when someone changes fields or they're in a job where they haven't been in there very long and they might be making very good money, but they haven't had a consistent pattern of making that money, especially in these categories that I'm referring to here. Now, if someone is salaried and just changed and went into a new job, well, we're going to use their new salary because it's salaried, right? So, but these other areas, and we work with a lot of borrowers, the whole industry works a lot of borrowers that have these other types of income that are either their full income or part of their income. And so we're going to need a 2-year history to establish that stability, and is it consistent every month or relatively consistent? Okay, moving on. So now we're going to get into the other 2 C's of lending. So capital. So we're talking about money here, right? I mean, that's the best way of summing it up. So what assets does the borrower have for down payment and closing costs? So we're going to look at, you're going to ask them about, hey, checking, what do you have in checking? What do you have in savings? What do you have in investments? Some people have investment accounts, retirement funds, gifts, and down payment assistance programs and grants. There are some good down payment assistance programs out there and grants, depending on a borrower's income. They are income-based. Those programs are all income-based. They can't make more than a certain amount of income in order to qualify for, some assistance. We see a lot of borrowers, especially, there's so many first-time home buyers now, as we all are seeing. A lot of borrowers are getting gifts. Some borrowers will take a loan off their retirement plan. Some, have enough money to come up with a down payment, the minimum down payment that is going to be required, but this money will come from a variety of different sources. And so we walk them through, every lender should be walking them through, what are all the available resources that they have in order to qualify. So where we go next? We go into key terms. So seller contribution, lender credit, and reserves. We didn't bullet point out the definition here on this. We're going to deal with seller contribution at the end, but let me tell you a little bit about lender credit and reserves. So a lender credit is when a lender is providing money back to a borrower at closing that they can use to offset some of their closing costs. So why would a lender do that? Well, there are situations where certain pricing on a loan is such that it generates $1,000, $2,000, $3,000 back to the borrower that they can use to help subsidize or cover their closing costs. Some lenders offer lender credits, some do not. Most do. We do at Valley as well. So think of it this way: if someone was going to qualify for a rate of say 3%, but just using it as a generic rate, but they're very comfortable at 3.25%, they can handle the payment. If you're very comfortable with the payment, and that 3.25% rate produces a lender credit of $4,000 back to them, which allows them to buy the home, then they may decide to go ahead and do that. Take a little bit higher payment, but get that big chunk of money back from the bank. So that's another way that we try to help borrowers get where they need to go. Last item here is reserves. So some programs do require that a borrower has money left over after closing, as what we call reserves. This was actually implemented by FHA over a year ago during COVID, where FHA requires the borrower to have 2 months of reserves post-closing. That means if their payment is $2,500 a month, they need to have $5,000 left over in retirement plans, other bank accounts, whatever it may be, that acts as a reserve, because FHA, Federal Housing Authority, wants to make sure that the borrower has money to draw on should they have, a difficult time meeting their payment obligation for whatever reason. Key tips: most loan primary residence programs require a minimum down payment of 3 to 5% of the purchase price. So borrowers are going to need 3 to 5% down at least, and that's going to be driven in part by other characteristics on their application. So strength of job, credit history is a big one. If you have much stronger credit, you're going to qualify for lower down payment programs. But generally speaking, 3 to 5% down is the minimum someone's going to need to come up with through a variety of different sources. It doesn't have to be the borrower's own funds. Gifts are very common, as I mentioned previously. VA and USDA. So VA is veterans. So doing a VA loan for veteran, active duty military, reservists, and USDA. USDA is an agricultural program, the United States Department of Agriculture. We don't see it too often in our area, but every now and then you will see that come up. Has to be in a specific area, for that program to work. But VA and USDA are two zero down payment option programs. I know that would make it challenging trying to get an offer accepted when there's no down payment, but someone could put down a down payment, $2,000, $3,000 in order to, make the seller comfortable, and we could still give them 100% financing. So, but they are zero down payment programs. And these programs typically don't require reserves, but FHA does as one example. So collateral, that's our last of the 4 C's. So what's the property worth? Obviously, we have to get an appraisal on a property. Surprisingly, well, I shouldn't say surprisingly, but the way the industry is moving is we are having more situations, still at a lower percentage, but we are having more situations where, depending on a borrower's credit history and the size of their down payment, we, from time to time, are getting appraisal waivers. What does that mean? That means we don't need to do an appraisal on the house, because the industry, Fannie Mae, Freddie Mac, all the big drivers and investors in the industry are realizing that, we need to have alternatives to requiring appraisals on every single loan, because, the appraisal industry, as far as number of appraisers out there, we need more people coming into the appraisal business and becoming appraisers. So the industry is understanding that and recognizing that and trying to find alternatives to take some of that load off of the appraisal world. So when a loan is deemed very low risk, very high down payment, low risk, great credit scores, we never know for sure if we're going to get an appraisal waiver until we run it through an automated underwriting system. But every now and then we'll get one. So you may have seen it already with a lender that you've worked with. They say, hey, no appraisal required. Well, that's going to be the reason. And again, we never know exactly if we're going to get one until we run it with a property address. Has to have a property address for us to know. Okay, so did it appraise for the purchase price? Obviously, that's very important. If it didn't, what do we need to do? So if it didn't approve for the appraisal price, for the purchase price, it didn't appraise for the purchase price, how can we restructure the loan to still keep it viable for the borrower? Is there any negotiation that's going to go on? We go into motion on, okay, what can we do? So it's never throw our hands up in the air. It's like, what can we do to try to still keep everything alive? Is the property condition acceptable to the lender? So that's another big thing. So we might hit value, but there could be some problems with the property that need to be addressed. And if it does need to be addressed, can we proactively address it prior to closing, or is it not something we can address prior to closing? And then we have to look at what are our alternatives in that situation. So key term here, loan to value. You'll hear from time to time, hey, my loan to value is 80%. That's 20% down, 95%, 5% down. So very simply, loan to value is calculated by loan balance divided by house value. That's loan to value. Most programs go up to 95 to 97% loan to value. Not all borrowers need that, but most programs will go up to that. Key tip, lenders will use the lower of the appraised value or purchase price in determining the loan to value ratio. So, we have to use which is the lower of the two. So if a house appraises above the purchase price, we're going to use the purchase price. If a house appraises less than the purchase price, we're going to use the appraised value. That's how, and lenders are consistent in all of this. This is not something that varies lender to lender. Okay, so those are our 4 C's of credit. And of course, we'll be taking questions on those, I'm sure. Now I'd like to hand it over to Rob to take us through the next couple of slides.
All right, so conventional loans and government loans, we're going to talk about those a little bit. I'm sure that once you guys get these pre-approvals from us mortgage folks, you're looking at your pre-approval and saying, all right, what kind of program are we going into? And this is where the big divide is. Conventional loans, and I'm going to go ahead and read a little bit off of here and then go a little off script, but conventional loans are loans that are either backed by investors like Fannie Mae, Freddie Mac. I know you always hear of this Mac and May family, right? It's like the Hatfields and the McCoys of the mortgage industry. So it sounds, but these are investors, basically. These are corporations that were started by the government, I believe back in the 40s, and really to help really home ownership. So these investors, as we call them, will buy back the mortgages that we write as lenders. And usually it's done, of course, after closing. But yet some loans are held back by the bank and put on their own balance sheet as a portfolio loan. Not sure if you ever heard of a portfolio loan. Every once in a while, that term will come up. I'll get the question, what is that? But a portfolio loan is essentially a loan that for one reason or another, the lender has chosen either not to just sell back to Fannie Mae or Freddie Mac and one of the investors, but instead prefer to keep it on their books, or there might be a reason, maybe they made an exception on something that it just requires or it makes more sense for the bank to keep it. On the other side, we have the government loans, or govies as we sometimes say. These I'm sure you've heard of: FHA, VA, USDA, even Sonny Mae, which is the state of New York mortgage. So government loans are insured by the government entity, which we're writing the loan to. They usually set certain guidelines. The difference in these particular loans is that they're a little less forgiving. I should say a little more forgiving to the customer, to the borrower in some respects. It could be credit, it could be past hiccups that they may have had, but not all bad. Sometimes we'll use these loans for convenience or it just makes sense to use it. Veterans, for example, great 0% option, USDA being the same thing. But the government loans, they tend to have a little bit more, they look at the properties a little bit more than the conventional loans do. So a lot of times, and this is where you have to be careful, if you've got a customer who has a pre-approval with a government loan, you want to make sure that the properties that you're showing these customers are in pretty good repair, in good shape. You don't want to have properties peeling paint, things like that, broken windows, that sort of things. A lot of it has to do more with safety issues. So that's a really important thing just to remember, that the government loans, a little more forgiving on the customer. There's a reason why the lender's probably suggesting that loan or we're going in that direction. I often get the question, can't we do a conventional loan? A more seasoned agent might understand that with the government loans, we have to be very careful of the property. And in this market, sometimes sellers haven't had the time to fix up everything that maybe that they wanted to do on that honey to-do list. So now they put the property on the market. You've got an FHA borrower, and all of a sudden we've got a potential issue. So conventional loan, if it works for the scenario for that customer, could be a good option. So that's the big difference there. So conventional loans, fewer property requirements versus the government loans. Conventional loans typically do require a bit of a higher score. So that's an important factor. Now that doesn't mean automatically if somebody's going with a government insured loan that they have an issue with credit. You shouldn't assume that. Again, there may be a different reason why the lender's going in that direction. So conventional loans, they typically require the higher score, a little less forgiving on credit versus the government. And the government loans, another important thing is to us as lenders, and why we're able to make these loans sometimes when we can't make a conventional loan, is that the government is essentially insuring these loans. So if there's a worst case scenario and there's a loss, we generally are covered in those losses. A couple of differences with conventional versus FHA, seller concessions, and that's something that we don't see in this market right now all that much. It seems most selling agents don't really want to entertain adding closing cost into a loan, or I should say into a purchase, because it could make appraising a little bit higher, but it is allowed. It's allowed on really all types of loans, but the rules are a little different. FHA, one of the government loans, is one that allows the most. That allows up to 6% of the selling price. And that's a real nice help if you've got a customer who's not working with all that much cash. They can't put all the money together. We always have a few strategies to get there if the seller concession doesn't work. But FHA, again, allows up to 6%. VA, a little bit less, usually about 4% of closing costs. And then with conventional loans, the rule splits up to a certain down payment. We can actually do 3% of the selling price as a concession to close. Whereas if you do a higher 10% or more, you can generally do a full 6% of the concession. So there it'll equalize with FHA, but that's basically the difference on those loans. I think.
Rob, can you comment on more flexibility on government loans relative to debt to income ratio versus conventional loans?
Sure, absolutely. And that's a really important point too. Sorry, I went right over that. But with the government loans, and I'll choose FHA in particular. I mean, that one has probably one of the highest of the standards on debt to income. What Mike spoke about earlier, debt to income being one of the measures that we use for affordability on a loan. So conventional loans generally want to hold that number down a little bit more. We'll see a borrower can typically go up to 43, 45%. In some cases, we can go higher, but generally that's about the maximum we want to go. Whereas if you have a borrower who's carrying a little bit more debt, maybe they have a little bit more student debt or credit card debt than the next family, that person, those borrowers can generally go right up to about 55% with FHA. That can mean getting into a home that they really love, a home that makes sense for their family. And just because they're carrying a little more debt doesn't mean they can't go ahead and get that. So a little higher on the debt to income with at least FHA and VA. So pre-approvals versus pre-qualification. This, I think, there's probably not a loan officer out there who doesn't get this topic come up probably almost every day. We typically like to start with offering the pre-qualification. When we speak with a borrower, we will go through what I like to say. It's almost like going to your doctor and doing triage. We're asking certain questions to see what direction we're going. And typically with what we're learning, we may go ahead and issue a pre-qualification with some minor documentation and running a basic application, but maybe that borrower hasn't yet given us everything that we need to do to fully vet out the income, the assets to close, things of that nature. So a pre-qualification, is really more the precursor to the pre-approval, which is really where we like to see most borrowers go to. That's where we have an opportunity to run a full application with full credit, go through that credit history with that customer, really make sure we understand what's there. They've met all of the qualifications for a particular program, and we have fully vetted out their income. We've fully vetted out all the assets to close. So we've collected pay stubs, W-2s. If they're self-employed, we'll collect tax returns. We will have those reviewed just to make sure everything looks good. So pre-approval definitely carries more weight, and we're seeing the requests come in most cases, almost right away. If we issue a pre-qualification, because maybe we're speaking with the customer, later in the evening, or it could be the weekend, they haven't had a chance to put all their documents together. So we'll issue the pre-qualification, at least so they can get out there and start looking right away if that's what they're hoping to do. But then we'll take the time to go ahead and work them through the process to get them pre-approved fully. So that's basically the difference on a pre-qualification versus a pre-approval.
And I think what you also see is, lenders still in the industry, there's still some significant differences between how lenders define what a pre-qual is versus a pre-approval. So, so when you receive a pre-qual letter from a lender or a pre-approval, just take a look at, what's the verbiage in there? Does it say that income and assets have been reviewed? Does it say this is subject to, pretty much everything, that we've essentially looked at an application, we've run credit, they say they work at, PepsiCo, they've got good income and credit looks fine. And they say that they have, $60,000 in the bank. So that's kind of your pre-qual. Pre-approval, as Rob mentioned, it's more of a validation. So, but, if you just see a letter and it says pre-approval on it, that doesn't necessarily mean, because there's such discrepancy in the industry still, it's getting better, getting a lot better than it was 10 years ago. But there's still some differences of opinion on that. So we're showing you what the vast majority of the industry says is a pre-qual versus a pre-approval. But that doesn't mean you couldn't have a lender that views it differently. So that's why it's important just to kind of dig into the letter a little bit, make sure you understand what's being said on there. As Rob mentioned, we'll issue a pre-qual when they can't provide us anything, right away, just so they can get out there and start looking at houses, right? We can back it up with a pre-approval later. But just a point for you to kind of look at that letter, especially if you're at the offer stage, right? Now we're making an offer. You want to be sure that your borrower is pre-approved. The other thing is lenders now, and it gets better every year, we have more and more tools today to pretty quickly validate a borrower's income and assets. We have some electronic tools that we use every day that can validate a borrower's income and their assets. They validate their assets with a link that we send them, and then we can validate their income if their employer participates in electronic income verification. So we leverage these tools for a few years now at Valley, and many other lenders do the same, where we're going to leverage these tools to go faster, right? To be able to get that analysis done so we can issue a pre-approval and we're not waiting a week to issue a pre-approval, right? So we leverage these tools. If a borrower is self-employed, then we do, if we're going to issue a pre-approval, we are going to look for at least their current year tax returns. Sometimes we'll ask for 2, depending on the situation. And, we're well trained on how to analyze those returns pretty quickly, so we can analyze them, determine what our income is, and then feel comfortable issuing a pre-approval instead of a pre-qual. So we have both letters at Valley, and depending on the circumstances, we're going to issue one or the other. But the key takeaway for you is understanding those terms, but then also look at that letter and make sure it says the things that you want it to say, especially if you're about to make an offer. Thanks very much, Rob. Okay, so let's jump into seller credit and seller contribution. So there is a distinct difference here, and it does come up from time to time. And it'll come up with the realtor, it'll come up with the attorney, it'll come up with the borrower. And we want to make sure that everyone understands how lenders view credit versus seller contribution or seller concession, because they're important differences. So a seller credit. So I'll just start reading here a little bit. Typically, this involves a seller providing a credit for repairs to the property that they don't want to complete, or perhaps they can't. They don't have the resources to complete prior to closing. It can also involve the replacement of something defective or something that's missing in the home, be it a refrigerator, an AC unit, a furnace, whatever. It could be a variety of different things. Lenders will reduce the purchase price of the home for lending purposes by the amount of the seller credit. So let me give you an example of that. So borrower's going to buy a house for $500,000, and they're going to do 90% financing. That would normally be a $450 loan that we're going to be providing. However, if there's a $10,000 seller repair credit in the contract when it comes over, then we have to adjust the purchase price to $490, because to us, and when I say us, I'm talking about the lending industry, the property is being sold for $490. Because a $10,000 credit is being given for something that is defective in the property. When I say defective, I mean, that's a big word, right? But generally we're saying something that is prompting the borrower to give a credit for something relative to the property. And that's the key difference, is it's something about the property, right? So that means that now we're looking at a $490 purchase price for the purpose of lending, multiplied by that same 90%. Now we're talking about a $441 loan. So the borrower is getting $9,000 less financing power because of the way that was put into the contract. And, if that's the way it has to be, that's the way it has to be. But sometimes when we see that, we see if there's other ways that we can structure that. So the other part here is when a repair credit or something relative to a credit for something in the property that has to be addressed but can't be prior to closing, a lender may require repairs or replacement to be completed prior to closing, right? So let's say if an appraiser went out there and it's a conventional loan and the appraiser didn't note anything that was that they deemed to be necessary to be addressed prior to closing. But there's something in the contract that says the seller's giving $5,000 for this because there's a couple windows that need to be replaced, right? So an appraiser might say, the windows were fine, they were functional, but there was, for some reason, buyer and seller agreed that they're going to get $5,000 to replace a few windows. And just because, the buyer wasn't comfortable with the quality of the condition that the windows were in, but they passed an appraisal. So we're still going to have that issue, even though the appraiser didn't raise it as an issue. So that's something that we deal with. And it's something that if it's in the contract, that will have an impact on, ultimately what the loan amount is. Now, if a borrower is putting down 30%, and we got a small little repair credit, it's not going to be impactful to the loan, but it could be required to be repaired or replaced depending on what it is prior to closing. So that's why, we would, we try to see if there's any other way we can address that situation. So key term, escrow holdback. So what does that mean? So escrow holdback is where a lender will allow a loan to close with a holdback. That means holding back some money from the seller or buyer's funds to ensure that the necessary repairs or replacements are completed post-closing. So you'll see this quite frequently when municipal lien searches come in and there's an open violation on the property and it's not going to be able to be addressed. We had this in COVID. It was much more significant because, everything was at a standstill, right? So no one from the building department's going out there to clear a CO, right? Or was taking forever. So if we have something that, is an issue that is not deemed to be overly significant, but it's just not going to be able to be addressed prior to closing, and buyer and seller and their attorneys agree to this, we can do what's called a holdback. So what's a typical holdback? So if the item that needs to be addressed was deemed to be $5,000, we might do a holdback of $7,500. We'll generally do, 1.5% of the amount. And then once it's completed after closing, we notify the attorney notifies us of that, or the borrower, and then we notify the attorney to release the funds. The funds are held by the attorney, and we notify the attorney to release that money to either the buyer or the seller. So escrow holdbacks are not, carte blanche across all lenders. So we will do some escrow holdbacks on a case-by-case basis. It's not just an automatic thing. We do it only when we need to. And we take a look at what is it that has to be held back and are we comfortable with that? There are many lenders that don't do it, and there are some that will do it or even have a formalized program on it. But just so you understand what that term means when you're dealing with a property that's got commonly what happens is it's got a municipal violation. So how are we going to deal with that if we can't deal with it promptly, right? The goal is to deal with it promptly and still close, but sometimes that can't be done. So now let's get into seller contribution. I know there's a lot of verbiage here. That's because it's a pretty involved concept. So I'll walk you through it, and then we can certainly take questions on it. So a seller contribution, or also known as a concession, is when a seller agrees to contribute funds towards a buyer's closing costs. So now we're not talking about they're giving them a credit because there's something wrong with the property or something about the house. Now what we're saying is the seller is saying, hey, I want to help you out with some money, which is all on paper, by the way. No money actually changes hands here. It's all a paper transaction. So seller's saying, I want to give you some money to help you with your closing costs. So closing costs are the costs to do the loan, but also taxes. That's all in the bucket of closing costs. So an amount, a dollar amount or a percent of the contribution is going to be limited, right? This can't be any amount. It's going to be limited by four things. One is the borrower's down payment. So the larger the down payment on a conventional loan, the larger the seller contribution can be. Number two, type of loan, conventional versus government. As Rob reviewed earlier, government loan, FHA in particular, allows you to go up to 6% right off the bat. Doesn't matter what the down payment is. Conventional loans are going to be more specific about if you've got less than a 10%, if you got 10% or less down, it's only 3%. So it's going to be limited by type of loan as well. Occupancy type. So if this is an owner-occupied property, it's going to have the best and most generous ability for a seller to contribute towards borrower's closing costs. Investment property, as an example, is only 2%. It's only 2% period. So an FHA and government loans are generally not involved in investment property lending. So you're limited to 2%. And the last one is total closing costs, including taxes. So what does that mean? That means that a seller can't contribute to a buyer more than what they need for closing costs and taxes. In other words, they can't contribute so much that the buyer is going to get money back at closing. It can only be, the max it could ever be is what the total costs are, but not to exceed these thresholds depending on, those four factors. Okay, so the agreed upon purchase price of the home is typically increased to account for the seller contribution or concession, basically same thing. So the seller still nets the amount that they require to accept the offer. So here's an example. So an offer is accepted for $500,000 without a seller contribution. Now buyer and seller agree that the buyer needs some help. Buyer says, hey, I need $10,000 to help me with my closing costs, or I would like that so I can get this purchase done. Seller and buyer agree. So in consultation with their realtors, they decide that, hey, let's bump the sale price to $510,000. That's the new sale price, and the seller is going to give back $10,000 towards the buyer's closing costs and taxes. In that situation, the seller is still going to net the $500,000 that they originally intended to achieve, right? So the seller is still going to net $500,000, and after deducting the $10,000 contribution at closing, they're feeling pretty good about the sale price. Lender provides a loan for 95%, say in a 5% down situation. 95% of $510,000 is a $484,500 loan instead of 95% of $500,000. So if there was no seller contribution, we would be providing a loan of $475,000. Because the purchase price is $510,000, we're now providing a loan of $484,500. The reality of all this is that at closing, the borrower now has $9,500 more in financing from the proceeds from their loan. So we're making a larger loan. And yes, on paper, the seller is providing that $10,000 credit. And that's going to help, that helps deals get done. Now, obviously, in the environment we've been in, seller contributions have not been very popular. They've been quite the opposite. But, as things always can change, and they always do in the marketplace, when these things start coming up again, you'll have an understanding of how to put together a seller contribution in an offer. So a key tip, the house must appraise for $510,000 for this to work unless the seller agrees to take less after the appraisal is in, or the buyer agrees to accept less or zero seller contribution. So in order to do a seller contribution for $10,000, where the seller is still going to get back $500 net at closing, their gross proceeds, the house has to appraise at $510,000. If the house appraises at $500,000, then we have to kind of go back to the drawing board and talk through, hey, is the seller still going to allow it? They're going to take $490,000. Is buyer and seller going to split the difference? And we're going to do, $5,000 seller contribution? Or is the seller saying, sorry, house didn't appraise, not my problem. It's $500,000. I can't give you any money. And then the buyer has to go, okay, I'm good with that. I'll come up with the $10,000 myself. So in the example here, I put house appraises for $505,000 instead of $510,000. The lender will now use $505,000 to determine the loan amount. The seller has to agree to the lower net proceeds of $495,000, which is $505,000 minus 10 is $495,000, to keep the $10,000 contribution in place. Or the buyer has to agree to a $5,000 seller contribution instead of the original $10,000 that they thought they were going to get. So that's, this happens from time to time. We have to massage that seller contribution and figure out if it's still going to be viable in situations where the house doesn't appraise. And that, that does happen from time to time, not too frequently, but it does happen. So that's the difference between seller credit. Remember, think about seller credit as property specific, and think of seller contribution or concession as buyer specific. I'm going to help the buyer, right? Seller credit is I'm giving a credit because there's something about the house that I'm doing that. That's the reason why I'm doing that. So that's the difference between the two. Okay, so I think from there, we'll just go into a little bit of Q&A. I think we had some questions in the chat, but before we jump right into that, just wanted to again thank you for your time today, and just ask Mary, do you want me just to go right into the chat, Rob and I, or do you want us to open it up? Chat? Okay. All right. So let's see here. I notice a lot of selling agents want to confirm directly with the borrower lender with regards to their assets. Do you know why this is becoming more a common practice? I've been told because of mistrust in the pre-qual pre-approval process. Yeah, I think you kind of hit it on the head there that, you know, sometimes, you know, deals are going along and deals accepted, offers accepted. And now the borrower and the lender start having more specific conversations and start getting into the details of the total cash to close, which is an important thing to talk with the borrower about from the very beginning so they know how much money they're going to need. You'll see in the industry, unfortunately, times where lenders just spit out pre-approvals or pre-quals and they don't do a full analysis with the borrower and say, hey, if you want to buy a house for $500 and the taxes are $13,000, this is how much you're going to need if you're putting down 5%, 10%, so that they're well educated, so that when they get an accepted offer and they come back to their lender doesn't say, okay, so we're going to need $75,000. And they go, what are you talking about? I had no idea I needed $75,000, right? So that's one thing. So the other thing is that a borrower might say to a lender, yeah, I have $60,000, like just kind of generally. And then a lender finds out later when they do some validation that there's very large deposits in the borrower's bank account in the last 60 days. And the borrower doesn't have any documentation to explain where it came from. It's mattress money, as we refer to it. And there's just no way of determining where the money came from. That can create a problem. Or the borrower says, yeah, I had that money, but it's money that I'm getting from, you know, a trust fund, and it's going to take 4 months to get it, or a variety of different situations. So, you know, we'll field phone calls from a selling agent from time to time asking, have we validated assets? Have we validated income? And, you know, I understand the reason for those calls. And so, you know, we can't get into specifics, but we will say, yes, I have looked at the assets and the assets would be adequate for what they're looking to do. And so it is something that is a relatively common thing that we're seeing, because deals have fallen apart when the lender didn't necessarily do their homework, or, you know, I don't want to put it all on the lender. Maybe the borrower said something that they just didn't understand. And just somehow there was a disconnect between borrower and lender that doesn't get identified until we're deep into the process, you know, in terms of an accepted offer and so forth. Next one. In New York, attorneys are not permitted to gross up a purchase price to account for a seller's concession. So the contract must include the concession amount. So what I'm saying is that if a buyer and seller agree to a certain purchase price and they feel that the price will, that the house will appraise for that price, the seller is providing a concession. They are technically providing that money, and that is in the contract where they're saying the house is being sold for $510,000, seller is giving $10,000 contribution towards buyer's closing costs, and so that it is legitimized in the contract itself. It's not that, you know, it's something that we're doing after the fact. So I hope that addresses that question. What are the benefits of a seller to do a concession? So when we're in more of a buyer's market and there's a lot of properties on the market and someone is trying to sell their house and they just can't seem to get a lot of people, you know, that are making offers. So they might offer a concession to a buyer to help someone buy their house and to make their home maybe a little bit more appealing in terms of the possibility of an offer. So let's say someone comes in, they've got an FHA approval, 3.5% down, but they're like, you know what, I don't know if I'm going to qualify because I don't think I have enough cash, and the seller says, well, I'll offer a concession, to try to help you in order to move their house, in order to sell the home. In days gone by, you would see sometimes, Mary, you probably comment this, or Kathleen, that, they would put into the listing that, seller will help with closing costs. And so, that was a common thing back in a buyer's market. In a market like this, you don't see it very often until we have more of a balancing out between buyers and sellers. Is that about right, Mary, Kathy?
I've seen that a lot. Yeah. Now it's, it is a seller's market. So
yeah.
Really...
So we'll see that come back more often as inventory balances to buyers, and who knows when that will be. But when we go back to more of a stable supply and demand, or if we ever go back to more sellers than buyers, you'll see seller contributions become more popular. If it's hard to sell a property, or the seller just needs to get out fast and has a RWA buyer that needs a concession. If it's hard to sell a property, the seller I'm not sure I totally understand the question.
Hey, Pam, do you want to unmute and ask the question? Pamela? Pam Jones.
Okay. Well, we'll jump down to the next one, which was when a buyer waives appraisal.
Did you call me?
What's that?
No, I heard one name. This is Pam Jones.
Hi.
We're having trouble hearing you, Pam.
Okay, let me try something else. Can you hear me now?
Yes.
Yes.
Okay. I didn't know whether you had asked if I had a question or you were responding to a comment that I made. I just caught the because I hadn't.
I didn't.
Yeah,
really
you were kind of garbled. We were responding to your chat where you said if it's a hard to sell property or the seller just needs to get out fast and has a RWA buyer that needs a concession.
RWA,
can you clarify it in the chat?
Yes.
Sorry, we can't hear you, Pam.
Okay.
Maybe you can clarify it in the chat, or we can have them get back in touch with you.
And Pam does make a good point about hard or difficult to sell properties. That's another situation where you will see seller concessions offered because it's a difficult property to sell for one reason or another, and you'll see seller concessions being offered, contributions being offered to help bring more buyers to the table. So I'm going to drop down to when a buyer waives an appraisal, the lender still comes to the property for the appraisal, correct? And Rob, you want to take that one?
In most cases we do, because the borrower, or in this case, the buyer may have agreed to buy it with the appraisal waiver, meaning they're going to go ahead and move forward regardless of value, but that still requires us as the lender to go out and understand the value because our loan is based on that value. In fact, we just had a recent experience like that where we went through that exact scenario. The customer had agreed to accept this property regardless of value, new subdivision, beautiful home, and we needed to make an adjustment later on because of the value. They moved forward anyways. We restructured our loan, but ours is tied to the value. Our loan is tied to the value of the home, loan to value, right? So that's an important part. We still do go out unless for some reason, as Mike mentioned earlier, when we first did that application, if we had gotten an appraisal waiver on our side, then we wouldn't need an appraisal. but we're assuming in this case, we have required the appraisal up front. When we did that application, we know that we have to go out there, even though the contract may state borrower is moving forward regardless. So yes, we do have to go out there and do that.
And we do see that quite frequently where buyer is waiving appraisal in order to be the successful bidder. And then we just kind of walk, and they'll frequently come to us saying, what does this mean to me? And then we will walk them through, what does that mean to you? So that they have an understanding. Okay, so let's see here. If there is a seller concession, does that change the way the property is appraised? Does the appraiser take into consider, for example, a 10K seller concession on top of the purchase price when determining the value of the property? So what happens is when an appraiser does an appraisal, they cannot complete that appraisal and submit it to a lender until they've reviewed the purchase contract. So in the purchase contract, it says the house is being sold for $510. So the house is being sold for $510. That is the purchase price. So, but it obviously says in there that the seller is going to help the buyer with a $10,000 contribution. As far as it pertains to the appraisal process, the appraiser is still appraising the property the way that he or she would have anyways. They are looking at that 510 and going, what is their opinion on the date that they did the inspection based on the comparable sales in the area? What is in their professional opinion, after they've done all their adjustments and they did what they call their grid, what do they believe that the home is worth, valued at, their estimated opinion of value on that date? So does that mean that an appraiser tries to hit a number like we used to say years and years gone by? No, they're going to do their due diligence and make sure that they feel comfortable that the comparable sales support the value that the home is being sold for. And so the appraisal process will not differ. They will be aware of it in the contract, but their goal is still to say, in their opinion, their professional opinion, what do they believe the home is worth X dollars? We've had situations where we get an appraisal in on that 510, the appraisal comes in at 525. So it doesn't always come in at like 510 magically, right? And we've had them where it's 510, appraisal comes in at 502. So the appraiser's always going to do his or her job, regardless of what they see in that contract. It just makes them aware of it. All right, so I had a client pre-approved with HSBC to move forward with buying a second home. The buyer came in with $100,000 at sale price of $299. We moved forward with the contract. After the appraisal was done, the lender decided the buyer was not qualified to move forward. Nothing changed with his credit or work history. How can I, as a listing agent, prevent this from happening in the future? So my apologies, I didn't have them pre-approved. They were pre-approved already, and they were represented by the buyer's agent. So, so that's, that is a challenging question. You would assume that with a pre-approval, 100,000 down, buyer would be fine. What I have seen and what Rob and I see is, listing agents will ask the selling agent, for the right to have a conversation with the lender and to confirm with the lender that, the borrower's income and assets and credit have been reviewed and validated, and that, this deal is going to be fine. So, we field those questions. And as I said before, we can't get into, like, if someone says to me, what's their scores? I can't convey what their scores are, but I can say their credit is excellent. Their credit is excellent. What are their assets? How much do they have? I can tell you that they have more than enough to do the deal, to do to transact. And, what do they make a year? Well, they make adequate income in order to be approved for the loan. And we have validated their income. Their income is stable and strong. No problem there. So, it doesn't mean that a buyer couldn't say to their selling agent, hey, if the listing agent wants me to provide a copy of my bank statement for them to be comfortable, that's up to a buyer to decide, and in consultation with their realtor. But when we are consulted, we will do our best to give the listing agent the information that they need without impacting anyone's privacy. And we do field those calls from time to time. So my answer to your question would be, if you have a concern about the buyer, and there's something that's giving you concern, maybe in your conversation with the selling agent, you're just not feeling warm and fuzzy, then you could always request to have a conversation with the lender. And I think for the most part, lenders will have those conversations to the degree that they can in terms of privacy issues. And I know that I know we're receptive to those phone calls because we understand you don't want to get all the way down the road and have a deal collapse that looked like it was perfectly fine from the beginning.
Mike, if I could just add to what you're saying there, and what I would encourage all of you guys as agents, whether you're new or whether you've been in the business as long as Mike and I have, don't be afraid to pick up that phone when you might be referring that borrower, that customer to a mortgage person, or they may have just come to you already pre-approved. If you don't have a relationship with the lender that they're working with, don't be afraid to pick up the phone and have a conversation with that loan officer and ask a few questions. To Mike's point, you can't ask we're not going to give you any of the sensitive information, private information. You wouldn't want that, spoken about on, of your own, right? So just ask the right questions. Like what Mike said, you want to make sure that the income has been vetted. Has the assets to close been verified? Have we picked up all of the documents that we need? Have we reviewed them? Tax returns for self-employed folks, just making sure that we've done our part so that they are in fact really pre-approved, because some lenders may just use the term pre-approval when in fact it's just an application that came in and maybe hit the magic button on a credit score and there goes the letter. But I know in our team, and many of the folks that work on a local level, we do a little bit of a deeper dive to make sure it's a real pre-approval, because we're local lenders. We're working with you folks every day. We want to make sure that we're not sending you out there, into the marketplace on a Sunday when you might very well be having dinner with your family. Instead, you're showing property and somebody is actually not even really qualified at that point. It's just not ready yet to move forward. So don't be afraid to ask the lender a few questions just to make sure everything's been done properly and that you're actually working. What you're working with.
Yeah. I think we're all out of questions, but if you do think of one, you can of course contact either Mike or Rob. This is being recorded, so we will have the recording to send around to you later on this afternoon. But Mike and Rob, I want to thank you both because it's really, really informative. And I think you touched on just about everything. It is kind of a complicated process, but you kind of broke it down and made it easy to understand for everybody. And hopefully, for agents, you'll be able to educate your clients, especially some first-time home buyers that, they can be overwhelmed with this whole process. But thank you both so much, Mike Muldoon and Rob Dominguez from Valley Bank. And hopefully we'll hear from you again. And thank you everyone for attending today, and go out and have a great day. Alrighty. Bye everyone.
Take care. Thank you.
Informative. Thank you.